Hey guys, what's up? I'm Erin and welcome back to the channel. Big changes are coming to retirement accounts, and if you're 50 or older, these are going to hit you sooner than you think. For the first time ever, the IRS is adding an income test to how you make catch-up contributions in your 401k and 403b. And if your income is above the limit, the way you save might look different. So we're going to walk through what's changing, we'll walk through an example, and how it might affect you. Before we get into this new $145,000 income test, let's clear up a common misconception about Roth accounts. When most people hear the word Roth, they immediately think Roth IRA. And with a Roth IRA, there are strict income limits. Once your income is too high, you're locked out of contributing directly. But employer-sponsored plans like a Roth 401k or a Roth 403b work differently. They don't have those income limits. So whether you make $50,000 or $500,000, you can still contribute to the Roth portion of your employer plan. This is why this new rule is such a big deal. For the first time ever, income limits are being introduced in a way to employer-sponsored plans. So if your income exceeds $145,000 and you're age 50 and older, it's going to affect how you can make your catch-up contributions. Let's start with the basics. If you're under the age of 50, your contribution limits are the same whether you're using a traditional or the Roth side of your 401k or 403b. For 2025, that limit is $23,500. Once you hit age 50, you unlock what's called a catch-up contribution, an extra $7,500 that you can now put in on top of the regular limit. Historically, you could direct that catch-up into your traditional or your Roth just like your base contribution, but this is where the new rule comes into play. Beginning January 1st, 2026, if you're 50 or older and your prior year FICA wages with your current employer were more than $145,000, then your catch-up contributions must go into Roth. The base amount, the $23,500, is unaffected. That is still your choice. You can either put that in a traditional or a Roth, whatever you prefer. But the catch-up amount itself has to go into a Roth if your income exceeds this limit. And keep in mind that this limit for income is indexed for inflation and will increase over time. There's also one more wrinkle. Starting in 2025, if you're between the ages of 60 and 63, you qualify for a brand new super catch-up. Instead of a catch-up contribution of $7,500, you can contribute $11,250 for your catch-up. And just like the regular catch-up, the Roth-only rule applies to the super catch-up contribution if your income exceeds $145,000. Now, to be very clear, the Roth-only rule for catch-up contributions applies only to employer-sponsored plans. Think 401ks, 457s, 403bs. It does not apply to IRAs. If you're over 50 and eligible to make that extra $1,000 catch-up contribution to your traditional IRA, you can still do that directly to your traditional. You're not forced to put it in a Roth, but keep in mind here, income limits do apply when we're talking about IRAs, so know where your income thresholds are, but just know you also get the choice when it comes to traditional and Roth when it comes to IRAs. And one last carve out, this change does not apply to simple or SEP IRAs. Plus, if you're in a 403b and qualify for the 15-year service catch-up, those contributions can still be made pre-tax even if you're above the $145,000 threshold. So the bottom line, high earners ages 50 and up will see their catch-up contributions or their super catch-up contributions if they're 60 to 63 strictly restricted to the Roth. Here's where things get really tricky. Your employer's plan design really matters. If your employer's plan doesn't have a Roth option by 2026, high earners, those making over $145,000 a year, will lose the ability to make catch-up contributions. So unless your employer adds a Roth option, if they don't have one, you will lose the ability to do these catch-up contributions if you're 50 and older. So now is the time to check with your HR or your plan administrator and ask if there is a Roth option in place if you're unsure. If there isn't, ask them if it's going going to be in place by the end of this year, 2025, or at least in place by 2026. Otherwise, you lose that ability to do those catch-up contributions. There are also a few edge cases worth noting. If you're new to an employer and you don't have wages with them in the previous year, that $145,000 limit doesn't apply. So that means if you're trying to take advantage of catch-up contributions, you get to decide, do you want to put it pre-tax into a traditional, or do you want to put it in a Roth? Your choice. Also, if you work for multiple employers, this $145,000 limit only applies per employer or per company, so it does not combine your income from all companies. And finally, remember that $145,000 limit isn't permanent. It is indexed for inflation, so we can expect that it will increase over time. Now, you might be wondering, why $145,000? Why that number? This wasn't chosen at random. The Treasury chose $145,000 under the Secure 2.0 policy breakpoint. It's based on revenue goals, policy trade-offs, and feedback they received during the rulemaking process. In plain English, it was a way for them to draw a line and say, who counts as a high-income earner and who gets to be eligible to make these contributions. Here's why this matters, because this line is lower than a lot of people might expect, and we might find a greater portion of people being swept into this Roth-only category. So why did lawmakers take this choice away from high-income earners? Well, honestly, it comes down to two things. First, revenue. When you make traditional contributions, the IRS has to wait decades before they collect tax revenue on these dollars. But when you make a contribution to a Roth, they get to collect tax revenue today. That's how Congress essentially paid for some of the other Secure 2.0 changes, like increasing RMD age. And second, the people most likely to use catch-up contributions are higher earners in their 50s and 60s. So that's where lawmakers aimed this rule, and it's part of an overall nudge to get people towards Roth accounts. So bottom line, it was less about retirement planning strategy and more about increasing short-term revenues for the government. That $145,000 threshold is lower than what many people would expect for a rule aimed at a higher earner. For perspective, the median U.S. household income in 2025 is over $80,000, and for households headed by someone age 55 to 59, it's over $100,000. Now keep in mind, those are household figures, not individual figures, but in that light, it doesn't make the figure of $145,000 really look like that much of a high income earner. And it's also worth keeping in mind that people in their 50s and their 60s, these are the individuals most likely to be in their peak earning years, so inadvertently, they may just find themselves swept into this Roth only for the contributions. Second, it really is on the employer and the plan administrators to make sure that their systems are set up that going into 2026, that the contributions are made only to the Roth account for the catch-up portion if this is a rule that is affecting their individuals. Finally, for the employees, it does mean you don't get any tax deduction for these additional catch-up contributions, so in the short term, it could increase your taxes, but know that it is going to a Roth where then it gets to grow completely tax-free. Short-term trade-off, maybe there's a long-term gain. Let's make this really concrete with an example. Let's say you're 55 years old, earning $200,000 a year, and your employer offers a Roth 401k. We'll compare two different scenarios. Let's say we have scenario one where you want to go 100% traditional contributions. In 2025, you could put the full $23,500 plus the $7,500 catch-up contribution into the traditional, reducing your taxable income all the way down to $169,000. Then, fast forward to 2026, you can still put the $23,500 into the traditional, that base contribution amount, but the $7,500 catch-up must go to a Roth. That leaves you with a taxable income of $176,500. Essentially, that's $7,500 more in taxable income because of the catch-up contribution. It's not eligible to go into the traditional portion of your plan. You can still make it, it just has to go into the Roth, so it's not eligible for that upfront tax deduction. Scenario two is all Roth contributions. So let's say in 2025, you made both the base deferral, the $23,500, and the $7,500 catch-up as Roth contributions. Your total taxable income would stay at $200,000. There's no deduction either way. Fast forward to 2026, nothing really changes. You still do your $23,500 into the Roth, plus the $7,500 into the Roth as a catch-up for a total of $31,000 in Roth contributions. Your taxable income still stays $200,000. For somebody who is already using an all Roth strategy, this new rule doesn't affect their taxable income or where they make their catch-up contributions. And it's worth pointing out, you don't have to be 100% Roth or 100% traditional. A lot of people split their contributions between the two, and that gives you the ability to go into retirement with multiple buckets to draw on. There is no one right way to approach it, and you can split your contributions however you choose. So the key takeaway is this. If you've been making your catch-up contributions to the traditional portion of your 401k, you're not going to be able to do that going forward if your income exceeds these limits, and you'll see that the taxable portion of your income then increases by this amount. However, if you've already been contributing your dollars, your catch-up dollars to the Roth portion of your 401k, you're not going to notice any difference at all. So why should you care? If your income is over that $145,000 limit, your short-term taxes are going to go up because you're losing the deduction that would otherwise be there for those catch-up contributions in 2026. This is also an opportunity to adjust your withholdings or your payroll elections so you're not surprised come tax time. On the flip side, this could be beneficial long-term. What if tax rates go up? You've now funneled more money into your Roth and it's accessible whenever you want it. If you've been building your financial plan around the assumption that you're going to be getting this deduction from these catch-up contributions going into your traditional and your higher income earner in your 50s and your 60s, now's time to revisit that plan a bit. So what should you do next? Number one, confirm with your HR or your plan administrator that the Roth feature will be there in your plan by 2026. Number two, check your payroll setup and make sure your catch-up contributions will be coded correctly as Roth. 3, update your tax planning. No more deduction on those catch-ups if you're over an income of $145,000. And finally, rerun your projections. Even though you end up paying taxes up front, the Roth can still be a very good long-term win. And keep in mind, it's only affecting $7,500 of your income. You still get to do those base contributions to Roth or traditional, whatever you choose. While we're on the subject of Roth changes, there's another Secure 2.0 update worth noting. For years, even if you were contributing to the Roth side of your employer's 401k, the employer matching contribution always had to go into the traditional, no exceptions. Now, employers are allowed to put their match or non-elective contributions directly into the Roth. That's new, but it's not required. Your employer must choose to add this feature, and some may delay, quite simply because administratively, it's fairly complex. Here's some things you need to know. You'll need to elect Roth matching if your plan allows for it. Those dollars must be immediately vested. They're yours right away. They're also taxable in the year they're made, showing up on a 1099-R, not your W-2. So why does this matter? For some, it's a powerful way to grow their money tax-free. But remember, those contributions are taxable to you, so it can increase your taxes in the short term, even though it gives you a bigger pool of money that you don't have to pay taxes on later. So make the call that's right for you. The bottom line is to know what options are available in your plan, and if your employer does now offer the matching portion of their contributions to be made to a Roth rather than a traditional, know how to select that if it's something you want. And as a wrap up for the entire video, if you're 50 or older and earning over $145,000 a year, your catch-up contributions are going to be all Roth starting in 2026. Make sure your employer's plan is ready, update your payroll and your tax planning, and turn this into an advantage if possible. Don't let new rules catch you off guard. Make sure you plan ahead. So what are your thoughts on this change? Leave your comments down below. below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. In light of that, it does kind of meek. We're dying over here. I'm so sorry. Do you see the streak of gray hair? I shouldn't film when I'm sick. Streak of gray hair. It's very upsetting. I feel like I'm too young to dye my hair. What age, if you dye your hair, what age did you start dyeing your hair? I'm 38. I thought I could hold on to this until like 50s. I'm hoping I don't have to dye my hair.